All right, let's get right into it. We all hear about government debt, right? These gigantic, almost unbelievable numbers get thrown around. Trillions of dollars. It's hard to even wrap your head around it. But what is the real cost behind that number?
Well, that's exactly what we're going to unpack here. And spoiler alert, it's not just about the interest payments, not even close. We're talking about a hidden force that can drag down our future, the explosive danger of a full blown crisis, and, the very real human cost that's happening as we speak. Yeah, you can really think of it as a cascade, a chain reaction with three totally different kinds of impacts. So we're going to break down each piece of that puzzle, starting with the one that's the most subtle, but maybe, just maybe, the most damaging in the long run. Okay, first up, this idea of a hidden drag. This is all about how a country's debt can quietly, almost invisibly, start to squeeze the life out of its most important asset, which is its ability to innovate for the future. It's not some sudden shock. It's more like a slow burn that can seriously mess with long-term growth. So you're probably wondering, how does that even work? Well, there's this concept economists call the risk channel. Here's the deal. When government debt starts piling up, investors, they get a little antsy. They know that sooner or later, someone's got to pay that bill, and that usually means one thing: higher taxes down the road. And that maybe creates a whole lot of uncertainty. Okay, let's follow the dominoes here. It's a pretty clear chain reaction. It all starts when government debt goes up. That creates that tax uncertainty we just talked about. Now, because investors hate uncertainty, they demand a higher return on their money to compensate for that risk. That's called a risk premium. And what does that do? It drives up the cost of capital. Suddenly, it's just more expensive for any company to borrow money and invest in new projects. But, and this is the key part, who does that hurt the most? The ones making the big, bold bets on the future. And look, this isn't just some abstract economic theory. There's real research to back this up, like this study from the Journal of Financial Economics. It found that the companies that are all about R&D, the real engines of innovation, they're the ones who feel this uncertainty the most. All of a sudden, their big game-changing projects become way too expensive to fund. So the bottom line is, high government debt can basically create a world where it's just cheaper and safer to stick with the status quo than it is to innovate. And that's a huge problem. So that's the slow burn. But what happens when the problem stops simmering and just boils over? What happens when we're not talking about a hidden drag anymore, but a full-blown, undeniable crisis? Well, that's when things get catastrophic, and they happen fast. Get this. In just the first year of a sovereign debt crisis, a country's entire economic output can drop by 3 to 5%. I mean, that is a massive, immediate shock. It's like a really bad recession hitting you all at once, practically overnight. But here's the scary part. That initial shock, that's just the beginning. The real ugly story of a debt crisis is how long it sticks around. These aren't wounds that heal quickly. They fester, and they last for years and years. In fact, when you look at the data from crises going back to the 70s, you find something staggering. 8 years after a debt crisis kicks off, a country's output is still down by 6 to 12% from where it should have been. That is literally a lost decade of growth. Just gone. Now, to really put this in perspective, let's see how these debt crises compare to other kinds of financial nightmares. And what the data shows is pretty clear. They are uniquely destructive. A debt crisis can wipe out 5% of output. Compare that to a currency crisis at 2.8% or a banking crisis at 2%. According to this research, debt crises are just in a league of their own when it comes to the damage they cause. And what if you get the worst case scenario? What if all three hit at the same time? A debt, currency, and banking crisis. We're talking about a triple crisis. The immediate damage can be a drop of over 10%. I mean, that's not a recession, that's a complete economic meltdown. Okay, so we've looked at the subtle, long-term drag on innovation. We've seen the explosive, catastrophic damage of a crisis. But now, let's bring this all the way down to the most personal, fundamental level: the direct, human cost of paying off these huge debts, especially for developing countries. So the numbers we're about to look at come from a policy briefing that really digs into where government money is going. And what it uncovers, well, it's a pretty stark reality. Right now, across the global south, governments are spending, on average, almost a third of their entire budget, 30%, just paying off debts. Think about that. That's a huge chunk of money that's going straight to lenders, not to the citizens of those countries. And this really highlights the brutal choice they're facing. It's a zero-sum game. Every dollar that goes to paying off debt is a dollar that can't go to building a new school, or hiring doctors for a hospital, or investing in climate solutions. And if we zoom in on Africa, where this problem is really acute, the numbers are just jaw-dropping. Governments there are spending 50% more on debt payments than they are on education, health, social protection, and climate action, all combined. It's 2.5 times what they spend on education, 4 times their health budgets, and an unbelievable 11 times what they spend on social protection. So you take a step back and you put all these pieces together. The quiet squeeze on innovation, the massive risk of a crisis, and the very real human cost. It becomes so clear. Government debt isn't just some abstract number on a spreadsheet. It's a global balancing act, and the stakes could not be higher. And when you look at numbers like these, it's no surprise that the authors of that policy briefing came to a very direct conclusion. In their view, the only path forward to rescue crucial development goals is to have a major round of debt cancellation and to slash these debt service payments and do it fast. And all of this really leaves us with one final, crucial question to think about. When a nation's debt basically pays for today by taking out a mortgage on its future, who is it that ultimately has to pay the price? From the innovator who never gets to launch their big idea, to an entire economy shattered by a crisis, to the kids who don't get the education or healthcare they need. I think it becomes pretty clear who ends up footing the bill.